it's I don't see how First Republic opens as First Republic on Monday morning.
On the Spot with Michelle Makori is brought to you by Prime XBT.
Inflation in March was hotter than expected, but it is cooling down. The core PCE rose 4.6% year over year, above the 4.5% figure that economists had anticipated. But it did decelerate from February, when it was up 4.7%. Now, keep in mind that this is the Fed's preferred inflation measure, and the market is very much focused on what we will hear from Fed Chair Jerome Powell next week. Well, it turns out that some Russian pranksters heard from Powell when they called him pretending to be Ukraine's President Zelensky. We're going to be playing some of those clips later in the show. Meanwhile, the Fed is blaming the collapse of Silicon Valley Bank on mismanagement and supervisory failures, compounded by a dose of social media frenzy that fueled fear and exacerbated withdrawals. That is according to a report looking into the second largest bank failure in U.S. history. And this all comes as First Republic Bank is teetering on the edge. Reportedly, it's looking increasingly likely that First Republic will head for FDIC receivership. So what would that mean for the banking sector? What would that mean for the markets? And what can we expect from the Fed? Let's discuss all of this with Mike Lee, founder of Mike Lee Strategy. Good to have you with us, Mike.
Thanks, Michelle. Great to see you again.
All right, great to have you with us. And again, a special thanks to our sponsors, Prime XBT. All right, Mike, let's start off with this inflation data. As I mentioned, the Fed's favorite inflation measure. It did cool further in March. The personal consumption expenditures price index rose 4.2% for the 12 months in March, down from an upwardly revised 5.1% in February. And the closely watched core PCE index, that's where the more volatile components of food and energy are excluded, that trended down as well, but a little bit more moderately. Core PCE up 4.6% for the year, slight easing from 4.7% that we saw in February. So you're looking at these inflation figures, you know what's happening with the GDP coming in at a 1.1% annualized pace in the first quarter, slowing down faster than expected, economists expecting 2% there. How do you see the Fed taking all of this into account? What's your read here?
Yeah, look, I think the Fed, they're waiting for 2% inflation. They are not. So the stock market and the bond market are both trading have had substantial rallies based on the promise of Fed rate cuts. No one has promised them that. They've just priced it in. And the way that I like to think about it is the bond market is looking out at things like Silicon Valley Bank, First Republic, and other things going on underneath the surface, particularly the commercial office space market, and saying at some point there is going to be a massive train wreck, which is going to slow everything down, cause a recession, and cause the Fed to reverse course. I would liken the equity market to a small child playing on those same train tracks. Okay. Right? Just sitting there wondering, not really understanding why these rate cuts are going to come, just hoping that they come.
Right, because what would prompt those rate cuts would be a pretty nasty turn in the economy, perhaps even a crisis that in the banking sector that could force an emergency rate cut. But saying all that, and I hear your point that the markets seem to be disconnected, the general consensus is for Powell to raise by 25 basis points at the next meeting. What say you?
Yeah, look, I think I think he'll raise at least once more. You know, we're going to talk about this later in the call that he had. He's talking twice more, but I think rates stay there. And I don't know that it matters if it's one or two rate hikes, as long as it's more rate hikes and that rates stay there and there's not an immediate pivot. And, you've heard Christine Lagarde mention maybe potentially raising the inflation target. You've heard nothing of the sort from Jay Powell. And the suggestion that he will, or that the Federal Reserve will, I think it's not really connected to reality. I mean, Jay Powell is digging his heels in. The amount of credibility the Federal Reserve has lost over the last decade, 15 years, and particularly the last 2 to 3 years, with the amount of balance sheet expansion, how they let inflation get out of control, how they called it transitory, and it's still here. It's Jerome Powell's life mission to get this in check, get inflation back down, not to 2.5%, not to 3%, but to 2%. And it's, I was just speaking with a friend of mine, and I would say he's like a Spartan with this inflation target. Bring me back with my shield or on it. And so I think if the inflation target does get raised by the Federal Reserve, it'll be with the new Federal Reserve chair, which is not out of the question.
All right. So Fed Chair Jerome Powell wanting to maintain his legacy here, as you said, because a lot of the credibility of the Fed has been diminished. And speaking of events that diminish Fed credibility, we learned that Russian pranksters heard from Powell when they called him pretending to be Ukraine's President Zelensky. Now, this apparently took place earlier this year, so we'll keep that in mind with the rate calls that he mentions. But a video call with Powell was recently shared on Russian television, and these comedians known as 𝗣𝗿𝗏 and Lexus are claiming credit for the stunt. Clearly embarrassing for Powell. He may take some consolation that these guys have been successful with prior targets, including Prince Harry and former German Chancellor Angela Merkel, and also Canada's Justin Trudeau. But they did prank him, and they did get some really interesting answers from him. So I want to play the clip and get your thoughts on the other side.
If the rate is raised further, the standard of living of the population will fall. So how much should it fall in order for the Fed to stop raising the rate?
We've raised rates quite a lot, and the market is already pricing in two more quarter percentage point rate hikes. We'll look around after we make those two, and we'll say, should we do any more? And then the question will be, how long do we keep rates at this level? And I think we'll keep them there for quite some time.
In other words, does the Fed think that inflation should be reduced to 2% at any cost?
Well, so we think we do need to reduce inflation to 2%. That is our obligation. But I think the path there, as we walk that path down to 2%, we'll also be considering, not at this point, but a little further on, we'll be considering, the effects on the labor market as well. That a recession is almost as likely as very slow growth. So that's a fact, and I think that is partly because of us having raised rates quite a bit. But this is what it takes to get inflation down.
All right, Mike. So the Fed said that, yes, Powell had spoken to someone earlier this year that he thought was Ukrainian President Volodymyr Zelensky. But the Fed also said that this video appeared to have been edited and they couldn't confirm its accuracy. Nonetheless, you're watching this. What's your takeaway?
That, if you've just been listening to what Jerome Powell is saying, nothing in that is new. All right. He can't publicly call out and say, we're trying to cause a recession or a recession is likely from this. But anybody who's followed the history of Fed rate hiking cycles know that a recession is almost intentional. And they're hoping that they can squeak by without one. But look, there's only two ways to get inflation under control: supply and demand. The Fed cannot create more goods or more services, but what they can do is crush demand by tightening monetary conditions. And that's what they're going to do until interest rates get down there. And so I think you see Jerome Powell behind closed doors talking with somebody he never thinks will go public. And it's very similar to what you see in public. So what you see behind closed doors is what you see in public. And that's kind of why I feel that these rate cuts that people are hoping for are not coming unless data deteriorates substantially.
Okay, so firstly, this recession that you're saying is practically inevitable at this point, do you anticipate a mild recession or a really deep recession?
So, that's hard to say. And it's, I've been thinking we're heading for a recession for a while now, as have a lot of other people, because if you look at what's happening with all the leading economic indicators, we're in basically a year of straight decline. The new orders index of the ISM survey has been in contraction for 11 of the last 12 months. Housing has basically collapsed. all these things that have historically been precursors to massive recessions, i.e. 2008, have happening, yet we continue to soldier along. And I don't know if that's because so much wealth has been concentrated at the top and these high-end consumers are able to kind of keep these top-line GDP numbers firing along. But I just don't see how a recession is avoidable. I would tend to believe, based on the stress we're having in the banking system and the fact that nobody can really get their arms around what's going on with commercial real estate. So the occupancy rate in New York City pre-pandemic was in the mid-90s. Now it's in the mid-40s, and that holds true for almost every major metropolitan area across America. Well, look, mezzanine financing went away for office buildings and commercial real estate in large part last fall. Okay, what is going to happen as these leases continue to roll over throughout the country? And if you think about a 3-story or 4-story office building, it's probably not that large in a tertiary market in America that's basically a third full, which was previously 100% full. Okay, that's a local, that's not Bank of America holding the note on that. That's a local savings and trust. And so from there, that creates a contagion effect on a lot of small banks. You know, after Silicon Valley Bank, we saw the largest 2-week decline in lending we've seen since it's been recorded. So I think something ugly is going to happen, and I think it's necessary to get inflation under control.
Right, and we're going to touch on First Republic Bank, but you're also saying that the markets are wrong if they're expecting a rate cut. So reconcile those thoughts for me. You're saying something ugly is going to happen, but the markets which are banking on a rate cut aren't going to get it, is what you're saying. So explain that.
So I think the bond market is looking at what I'm looking at. Okay, and the stock market is just looking for these rate cuts. And the other thing is my opinion on the stock market being overvalued and we're due for some sort of correction is very much widely held in the consensus. And so
sure, is the market going to get that pivot? Which again would mean bad news, but that seems to be part of the rally.
Yeah, well, I think we're looking at a short squeeze here, and that when you have when there's a large consensus, it's usually wrong. Unfortunately, I'm positioned, and I'm not short the market, but when you have this large consensus that the market's going to go down or that the market's going to go up, a lot of times it can get pushed the other direction for very much that reason. And so I think there were a lot of people short into these tech names this week. And then what you saw is short covering. And like the most popular shorts were these mega cap tech names, which were the most popular longs in 2021. And people trying to chase performance and catch up were short into them to the end of last year. And you're just seeing the reversing of those trades on a massive scale.
But at the same time, I hear that point, but at the same time, we have had a crop of solid earnings. In fact, just over half of the S&P 500 companies that have reported earnings thus far, 80% of them have beaten expectations, according to data from FactSet. And that beat rate is roughly in line with a 3-year average, according to data from the Earnings Scout. So we are getting companies being resilient. I know that this is a backward indicator, but you're saying none of this is enough to be a bull in this environment.
Yeah, well, look, 4.7% earnings decline, and the estimate for the fourth quarter is an 8.2% earnings growth. All right. And the market's right now trading at about 19 times forward earnings, if you believe those earnings will come into fruition. Okay, you can make that case when the front end is at 0 and the 10 years sub 2%. Okay, when the 10 years at 3.4, 3.5%, and the front end's at close to 5% in a decelerating economy with tightening liquidity, it's hard to make that valuation argument. And like, look, Microsoft had a pretty good quarter, but it's trading at 32 times earnings, right? And you look, and so Amazon reversed course last night based on the growth of the cloud computing. And I'll tell you, if you look at cloud for Google, for Microsoft, for Amazon, they all have the same rolling over trend to them. It's just, it started earlier at Amazon because Microsoft was taking share. So look, markets can remain irrational far longer than you can remain solvent. And I am not short this market. I'm just long the defensive sectors, and I'm underweight equities relative to what I have been historically.
All right, so break down your position and how you're handling what you're expecting to come.
Yes. My equity model is 10% cash, 20% the long bond, TLT, and then the rest is consumer staples, utilities, energy, healthcare, and gold.
Break us down with some of those specifics. Which consumer staples, which defense stocks?
Yeah, perfect. So I try to stick within just the S&P 500 ETF sector, so it's easier to move, easier to manage. So XLP, XLV, XLU, XLE, and then for the purposes of trading, I use GLD. For the purposes of ownership, I own physical gold.
Okay, we're going to get your outlook, because last time you were on, I believe you said you expected a $5,000 gold price. What are you looking at for now? Because gold has been struggling to break past 2,000. What do you think we're going to get? I believe last time you were on, you said that gold should be valued at 5,000. Do you still hold that call?
So here, if we get a meaningful breakout above 2,000, so I think in this financial calamity, maybe we avoid it, and there is definitely a possibility I could be wrong, and markets are predicting I'm wrong. But I think something bad is going to happen. I don't know exactly how. But at that point, if you get a meaningful breakout in gold, the cycles are 2.5%, 2.5 times the previous high. So the last cycle we got from 7,800 to 2,000. Before that, 200, 250 to 800. So I think 2,000 takes us up to close to 5,000. I think that's where you get to in this cycle, that 2.5x times the previous high. That's where I'm coming from a technical standpoint. The same way in Bitcoin, you see a test of the previous cycle high and then a triple of that previous cycle high.
Over what time period do you see $5,000 gold?
Well, look, it depends on it. So if we have a meaningful breakout above 2,000, that's a 2 to 3 year period.
Okay, so in 3 years' time, you're seeing gold at least 5,000.
Well, we first need to see a breakout to 2,200, 2,300. If it meanders around 2,000, I think there's worse things that you can own in this environment. But if we don't get it, if the naysayers and the bears are able to keep that lower or keep us in this range, and we don't have that breakout, then we could be stuck here for another decade.
Okay, but you're saying that you believe something really bad is on the horizon, and that's what would force gold to take this position. And I want to go back to that clip from Fed Chair Jerome Powell with those Russian pranksters, because he was asked about what kind of crises he expects or what he thinks could be problematic on the horizon. And he gave some very interesting answers there. Let's watch.
What kind of risk do you see for world economy now, and especially for the US? What is your assessment?
So when growth is very slow already, any kind of a shock, any kind of a negative event, whether it be problems with a new COVID strain or some kind of terrible event in Ukraine that turn that we don't want to see in Ukraine, something like that, some negative shock that could put the U.S. economy in recession. You ask for risks, the risks are clearly, what happens in Ukraine is really going to matter, and clearly what happens in China will matter. In the United States, I think we have a risk from this thing you're reading about, the debt ceiling. There's going to be a big confrontation in the next few months. There's a battle over what it will take to get the debt ceiling raised.
Okay, so Mike, Fed Chair Powell basically saying that we can't stomach a black swan event right now, that would be pretty problematic, and also saying that the debt ceiling default is a big problem if it's not raised, and especially in this era of political fighting. What do you expect?
Yeah, look, to me, the debt ceiling, like the last time we went through it, is, I don't want to call it a non-event, but it's the notion that the U.S. would default under debt, Social Security or Medicare, is just a blatant total falsehood. There's more than enough tax receipts coming in to service the debt, service Social Security, and service Medicare. And then after that, the Treasury Department will have to start making decisions as to what order of payments they want to pay out. And I think this is the Republicans' only point of leverage. And, it was different in 2011 or 12, the last time they had it, because now instead of 12 or 13 trillion in debt, we're 32 trillion in debt.
Right.
So it's, for them to make historical comparisons as well, you've always raised it before, it's just not applicable. But the fact of the matter is the U.S. is not going to default in their treasuries. If there was a realistic chance U.S. treasuries were default, the 10-year wouldn't be at 3.5%, it'd be at 35%. So maybe CDS will bounce around, but those are, who trades CDS on U.S. treasuries other than pure wild speculators?
All right, but as you said, this has happened before, but this time it's different, especially in the context of a potential banking crisis, which I want to get to, and also in the context of this de-dollarization trend, where we're seeing some of the world moving away from the dollar and losing faith in the dollar. So if there is a default on the debt ceiling, surely it's different this time.
Yeah, well, so there won't be a default on the U.S. debt. There's more than enough money coming in to service that, Social Security, and Medicare. So unless Janet Yellen actively chooses to default on it, there will not be a default on the U.S. debt. Okay, and in terms of the de-dollarization, at some point it'll come, but it's so far away from happening because there's no other material liquid bond market in the world. So when you're merchant trading with another nation and you have an excess of their currency, what are you going to do with it? You need a widely traded, broad-based, safe bond market, and the U.S. bond market dwarfs anything else in the world. So while we may, we definitely will de-dollarize. It's just, is it 5 years or is it 100 years? I don't know the answer to that. I tend to think it's probably longer than 5 years. But from a logistical standpoint, until another currency emerges with a widely traded, reliable bond market where people can store their excess reserves, it's simply not realistic. And you can get into some merchant trading with these countries and trying to band together at BRICS and put together global trade deals. But, then you've got, Russia and China as two of your major trading partners. And if that's the direction you want to go, I can't say it's going to end well for you, going forward. So until something can replace King Dollar, which will happen, there's nothing on the horizon right now. I don't believe that's going to happen. And then
what about this potential BRICS global reserve currency backed by commodities that the BRICS are working on? Do you see that as an alternative? And
no, because what do you do with your excess reserves? Like,
okay.
you just keep it in oil? Like, you're gonna? It's not realistic. It's unfortunate that this is happening in the U.S. from the way that they reacted to Russia's invasion to Ukraine, and it weakens us as a country. But in terms of dollar supremacy, you're still a ways away logistically.
We've had guests say 10 years, about 10 years' time, the dollar will start to meet its demise, not be completely taken out, but at least has around 10 years of being on the throne, more or less, left. Do you agree with that timeline?
Well, look, a lot of things can change. If we have $2.5 trillion deficits every year for the next 10 years, it could be shorter. If this budget framework makes its way through and then you're on a path to a balanced budget, you may never get there, but you have a $24 trillion GDP growing at 2% a year and your deficits, less sub $1 trillion, we can keep chugging along for a while until another currency with the widely traded bond market, stable economy emerges, and then the beginning of the end. And that's part of the reason why the U.S. was able to take over from the pound.
Right. Okay. I do want to get your thoughts on First Republic Bank, because part of the issues, as we discussed, with the Fed tightening credit is the impact that it's had on the banking system. And for the longest time, the speculation was that the Fed is going to raise something until something breaks. And we're seeing cracks in the banking system that could be that breaking. So with regards to First Republic Bank, reports that it could be taken into receivership by the Federal Deposit Insurance Corporation, the FDIC. There's still some hope for a rescue deal here to occur before the regulators step in. And just as a reminder, there's exacerbated panic after they revealed in their earnings that deposits dropped 41% in the first quarter. And that was even after a consortium of banks stepped in with about $30 billion there. So we've got shares plunging around 96% year to date from First Republic. What do you expect?
Yeah, look, it's right now it's Friday at 3 p.m. I think at 4 p.m. The FDIC is there, and then this is the end of First Republic, and it's unfortunate, but no bank can handle a run on the bank, and so it becomes, how well does the Fed contain this? I'd imagine they backstop the bulk of the deposits.
You're saying you do see this happening over the weekend? I mean, these things do tend to happen over weekends, especially as we're hearing rumors about them.
Yeah. Look, it's I don't see how First Republic opens as First Republic on Monday morning. I just that earnings call on Monday was where they not so much the earnings, but the state of the balance sheet was horrific, and that's it. And it's which banks are next. And this is, again, with commercial real estate bubbling under, bubbling over, this is I don't see how we coast through this rate hiking cycle and the Fed just pivots without some sort of calamity happening. And if you go back to 2008, it was in 2007, the Bear Stearns hedge fund imploding in the summer of 2007. And, I remember walking up to the bond desk at Morgan Stanley, and the head of trading said there are no bids for anything and there was no liquidity. Well, that was the first liquidity event. And then the credit event was 9 months later when Bear Stearns went under.
Okay, I know we're running out of time with you, Mike, but I've got to circle back on this point. You're saying you do not see First Republic opening for trade Monday morning. You're thinking things are going to go down this weekend.
I think 4:01 p.m. I bet you. I bet you the bank examiners are sitting outside in their cars of their headquarters, drinking coffee, ready for a long weekend.
So what would that mean? What kind of market reaction do you think we'll get if that happens?
I don't know. I believe it'll be a lot more subdued than Silicon Valley Bank, simply because anybody who paid attention on Monday knew that there was no chance. And, Silicon or First Republic may find a strategic buyer. There may be somebody that wins this in a fire sale, and they're more prepared because they missed out on the bidding for Silicon Valley Bank, and it may get gobbled up over the weekend versus a quote unquote failure. But I can't see First Republic opening up for business on Monday morning.
But you're saying market reaction would be subdued because it's kind of expected already?
Yeah, yes. I mean, the stock's trading at like $2 or $3. So,
well, I mean, market reaction at large, as we're seeing yet another bank tank. I mean, in terms of if you're looking at this, what it reflects for the banking system, surely markets are going to get spooked by another bank failure.
I would just say this one, people were wondering. So I think it was Westpac Bank. I maybe is the next one to look for. The other one involved in crypto space. Not crypto, venture lending. There are five main venture lenders. Comerica Bank, which would have a very small portfolio. First Republic, Silicon Valley Bank, where the venture community was the bulk of their client base, and then Westpac Bank had a very techie client base. So First Republic is a San Francisco bank. So, I mean, Signature Bank is already gone. So is Silicon Valley. First Republic didn't have to go, but when you have a run on the deposits, no bank can withstand it. It's what's a Miracle on 34th Street, the movie from 1940. You can't handle no bank can handle a run on the bank.
Mike, it's sounding to me like you're pretty much expecting a consolidation of the banking sector here.
Yeah, we'll see. I mean, if this commercial real estate scenario plays out the way I think it will, you'll see a lot less small savings banks across the country.
Well, what does it mean for economic freedom if we're left with like 8 major national banks?
I don't think we'll ever be left with 8 major national banks, but we could get the number of banks cut in half just from consolidation. We'll never be Canada with 5 or 6 major banks, but I think this consolidation is, look, it's what's breaking. It's what's going to that collapse in lending that you're going to see countrywide is what's going to slow the economy down. It's what's going to get inflation under control.
Are you buying some of these banking stocks, some of the big players that you think are going to gobble up the small ones?
Look, their loan loss reserves are not. If this plays out, so the yield curve is upside down, and if the Fed cuts, okay, these banks are going to lose their key earnings vehicle, which is taking deposits that they pay zero on and parking them at the Fed and getting close to 5%. So that's the bulk of these big bank earnings right now. And so it's going to take the Fed a long time for that yield curve to get steepened, for them to be able to make easy money. And I think of the easy money they could make, M&A, new issue underwriting, new loans, all these things will collapse in addition to loan loss reserve spiking. So I don't know how and why the banks are doing so well. And there were probably some trades in there. There'll probably be some trades on Monday or Tuesday if First Republic goes under with some of these other banks that the market thinks they're gonna and don't. But that's gambling, and it's not really my forte.
All right. So very quickly, finally, what are you advising your clients?
Yeah, look, I'm never all the way out of the market, and I'm never all the way in the market. Short-term interest rates are 5%, 4.5% in money markets. So there's nice yield there. Preferreds, you're looking at 8% interest rates. There's some other creative credit products out there where we can hit our benchmarks, and then we're just going to own stocks, but we're going to own the most defensive sectors.
All right, Mike, thank you so much for your time. Mike Lee, always appreciate it. Thank you.
Thank you, Michelle.
All right, and thank you for watching. I'm Michelle Makori. Keep it right here.
On the Spot with Michelle Makori is brought to you by Prime XBT, the leading cryptocurrency trading platform.